Something really strange is happening in the housing market right now. Foreclosures are rising, affordability has collapsed, the economy is slowing down, and consumer confidence is weakening, yet somehow, home prices are not falling. In fact, in many places, they're still going up. It feels like all the warning signs of a major crash are flashing at the same time. But the crash itself is nowhere to be seen. It's almost as if the housing market is breaking and holding together all at once. The more you look at the numbers, the more this strange picture actually makes sense. Let's start with the issue everyone is talking about, foreclosures. This is usually the first indicator that homeowners are struggling, and the latest numbers definitely show stress. Compared to last year, foreclosure filings are up by 20%. Even more concerning, this is the 8th straight month where foreclosures have increased. If you just look at that number, you might think the market is on the edge of disaster. But here's the twist. The total number of foreclosures today is still far lower than what we saw during the 2008 housing crash. Back then, it wasn't a small rise, it was a complete flood of distressed homes hitting the market. In 2010 alone, nearly 3 million homes went into foreclosure. When you have that much inventory dumped on the market instantly, prices have no option but to collapse. Today, we're nowhere near that level. Right now, only about 0.5% of all U.S. mortgages are in foreclosure. To understand how low that is, remember that the historical average is around 1.5%. So yes, foreclosures are rising, but no, they are not high enough to trigger a price crash on their own. This is pressure, but not panic. The real question is, if American households are under so much financial stress, why aren't home prices falling? How is the market staying so stubbornly strong? The answer begins with interest rates, and this is where the story takes a dramatic turn. Millions of homeowners are locked into mortgage rates they will never see again. Some have rates below 3%. Many are between 3 and 4%, and roughly 72% of all mortgage holders have a rate under 5%. When you hold a rate like that, selling your home becomes almost impossible, not because you don't want to sell, but because you can't afford to buy another home at today's rates. People call this the rate lock effect, and it is one of the strongest forces holding the housing market together. Homeowners are staying put. They're frozen in place, and because they're not listing their homes, the supply of available houses keeps shrinking. When inventory stays low, prices stay high. Then comes the second major force, equity. In the last 5 years, home prices climbed so quickly that millions of people built huge amounts of equity almost by accident. Anyone who bought before the pandemic is sitting on tens, sometimes hundreds of thousands of dollars in home value. This equity acts as a financial safety cushion. If a homeowner gets into trouble, they're far more likely to sell for a profit instead of losing their home to foreclosure. This is one big reason why foreclosure numbers, while rising, are still controlled. Now let's talk about prices. The median U.S. home price is currently hovering around $440,000, which is about 1.4% higher than last year. That might not seem like a big increase, but when affordability is this bad, any increase is surprising. And the reason prices are rising isn't demand, it's the severe lack of supply. The United States simply hasn't built enough homes for decades. Depending on which expert you listen to, the nation is short anywhere from 3 to 4 million homes. This shortage is so deep that economists say it will take 5 to 7 years just to catch up. This imbalance, low supply and steady demand, is the biggest reason prices are not falling. A price crash requires an oversupply. It requires a flood of listings. Right now, America is dealing with the exact opposite problem. Of course, not every state is following the same pattern. Some areas are showing more stress than others. Florida is currently at the top for foreclosures per housing unit, followed by South Carolina and Illinois. Florida in particular is dealing with massive insurance issues and investor pullback. Meanwhile, parts of the Midwest and Northeast are still seeing prices rise steadily. This is why national averages can be misleading. There is no single housing market in the United States. There are hundreds of local ones. So what about the future? Will we see a housing crash? Every year since 2021, analysts have predicted massive price drops, and every year the market has refused to fall. Could we see a correction? Absolutely. Some cities are already adjusting downward. But a nationwide crash like 2008 would require millions of homes to hit the market. And right now, nothing is pushing that to occur. People don't want to sell. Banks aren't giving out risky loans. Investors are converting homes into rentals instead of selling. And the biggest reason of all, supply is still far too low. We are in a housing market unlike anything in modern history. A market with rising foreclosures but still low overall numbers. A market with terrible affordability but stubbornly strong prices. It's not a bubble like 2008, and it's not a healthy market either. It's something in between. What we're heading into isn't a dramatic collapse, it's a slow squeeze. A market where buying becomes harder and homeownership becomes something fewer Americans can reach. If you want to know where the market is going, forget the headlines. Watch the three numbers that never lie: inventory, interest rates, and unemployment. Those numbers will decide whether this unusual calm finally breaks. If you found this breakdown helpful, make sure to subscribe for more deep dive analysis. Thanks for watching.